So retirement income can include Social Security benefits as well as benefits from annuities, retirement or profit sharing plans, insurance contracts, IRAs, and etc. Retirement income may be fully or partially taxable depending on when it's been withdrawn. So this is what a standard 1099 looks like. Mostly all of them come exactly like this. There is an exercise that wants you to calculate the taxable portion. I think did we do the worksheet for that, for the simplified method?
Yes.
So we will do a worksheet. That's the only bit of math that you actually have to do with volunteering. In the real world, we may not see it, but there is something in the certification test where you have to calculate the simplified method. We will talk about that when it comes about. But for the purposes of this form, at the top, box 1 is the gross distribution. Then there's the taxable amount in box 2. And then I'll ask you if the taxable portion is shown for the total amount or if it's not been determined. And then we look at box 4 for the federal income with tax withholding. And then we also look at box 7 as well. And this will tell us what type of retirement or annuity it is based on the code. And if it's an IRA, it'll have this box checked. So that's what it looks like. We'll have one that has actual numbers in it. Any questions on a retirement form? Pretty simple? Yes? No? Cool. All right. So partially taxable pensions and annuities using the simplified method. And this is the one that I was speaking about. We will do the simplified method and figure out how to calculate the tax-free portion for each pension for the annuity payment. The simplified method calculates the taxpayer's cost basis for each monthly payment. It's calculated by the number of months payments is based on the taxpayer's age. So you have to figure out the taxpayer's age at the start of the annuity, and then the amount that was already received, and then less it from that. And we will actually do this example from the certification test. So disability income, generally taxpayers who retire or are disabled or on disability must include all the disability payments in their income. Disability payments are taxed as wages until the taxpayer reaches a minimum retirement age. This age is set by the employer. After the taxpayer reaches the minimum retirement age, disability payments are treated as pension income to determine taxability. It sounded like a lot, but it's just a form of income through disability and or annuity. So how do we actually put that in the system? This is what the software looks like for TaxSlayer. For both the 1099-R, the railroad benefits, and the Social Security benefits, as well as the non-taxable distributions. The most common one that we see is the Social Security benefits and the 1099-R. So it follows the same form as all the rest of them. We say who it belongs to. We put the demographic questions or segment on the left, and we put the distributions, the taxable portions, on the right. Oh, sorry. Where did I go? There we go. So we will do the simplified method once we jump into the software. This is just kind of where you locate it. And so this is how you put it into the software. So once we calculate the plan at the start date of the annuity, we'll do when the starting date of the annuity happened, and then we'll put the age here at the bottom, so the age of the recipient when the start date happened. And then the system will calculate the simplified method for us. But we will do the math together, so don't worry just yet. And if it's a rollover, we can indicate that within the software as well. And that's what it looks like. So, you don't include if your gross income qualified distributions or distributions that are a return of the regular contributions from your Roth IRA. Distributions from the Roth IRA are tax-free and may be excluded from income if the following requirements are met. The distribution is made after the 5-year period beginning with the first day of the first taxable year for which a contribution was made to a Roth IRA set up to the taxpayer's benefit, and the distribution is made on or after age 59 and a half, or because the taxpayer was disabled, or made to a beneficiary or to an estate, or to pay certain qualified first-time home buyers amounts up to $10,000 for a lifetime. So there's just some rules for the Roth IRA in which it wouldn't be considered taxable. Qualified charitable distributions. These are there's not really much to discuss on this page. Yeah, I'll leave that alone. During the COVID years, there was a provision that was given to these individuals that were laid off and then had to take their retirements. And so there are some coronavirus-related packages that had some different level of intricacies for the tax return for retirements. I don't believe it's going to be for any of these tax years, so we don't need to worry about this unless you do a past year and they did receive a retirement in that year. But I'll leave this alone because those individuals have already paid this off. So for those individuals who got laid off in the first year of the pandemic and they had to assume their retirement because they were laid off, they could do a 3-year spread, and so they could spread their liability throughout the 3 years and wouldn't have to pay that all up at once. But the last person was last year, so that's good to go. As well as repayments, a qualified individual who received a coronavirus. So it's still the same thing. This is just more detail on that. They just had to pay it through this 3-year spread. There's nothing here that I can think of that's really important because we're technically out of the pandemic now, so we won't go too far in detail about that. And that was for the deferred payments through the 3-year spread for coronavirus. So here are some of the codes that you will see with the retirement plan. The most normal one, or the most common one, is distribution code 7, 1, and 3. You don't have to know these in depth. These are just the ones that you'll see most commonly when you're at a site location. So if they ask, oh, okay, well, it's just a normal distribution. It's nothing to do, really. They do have their own different things, but they're just telling you more information about what type of money this is and where it came from. And code G as well, and that indicates a rollover. Ooh. And so if they have numbers or letters, they're just telling you what kind it is, what happened, and where it went. All right, so let me read this question. Andrew changed jobs and received a Form 1099-R from his previous employer. The gross distribution amount is box 1 is $11,200. Andrew deposited the entire $1,200 into his IRA within 30 days of receiving the check. Which of the following statements is true? The entire distribution is includable as income. The entire distribution is excludable from income. The distribution is eligible for the 10-year tax option. The distribution is eligible to be taxed as a special rate. What do you guys think? That's correct, because it got rolled over to the IRA, so we wouldn't count it as actual income. Does that make sense? Because they didn't actually assume the value. If they would have put it into the savings, like the example earlier, then yes, that means that they received it and that they're going to use it for something else.